Netflix reported 208 million global subscribers as of the end of the first quarter, missing its own prediction for 210 million. The streaming giant did beat financial targets, though with earnings per share of $3.75 coming in well ahead of Wall Street analysts' expectations. Revenue of $7.16 billion also topped the street. The subscriber shortfall, which caused the stock to drop more than 10% in after-hours trading, was blamed on issues related to the coronavirus. Simply put, the pandemic gaveth, but also taketh away. We believe paid membership growth slowed due to the big COVID-19 pull forward in 2020 and a lighter content slate in the first half of this year, due to COVID-19 production delays, the company said in its quarterly letter to shareholders. We continue to anticipate a strong second half with the return of new seasons of some of our biggest hits and an exciting film lineup. A degree of uncertainty about COVID would linger in the short term, but the long-term trend of streaming replacing linear TV remains in effect, the letter affirmed. Net cash from operations surged to $777 million in the quarter from $260 million and free cash flow of $692 million was up from $162 million. Netflix confirmed a key metric, that it's on track to free cash flow break even this year and doesn't need outside financing anymore to fund day-to-day business. That was a milestone affirmed in the company's January report, and only reaffirmed the bull thesis as the entire entertainment business continues its shift to streaming. Another advantage the company sees in its service is low churn, with the rate in the quarter dropping below the year-ago level. Already, Netflix's mid-single-digit churn is the envy of the industry. Also, having a stable base of subscribers gives the company pricing power. As we improve the service, we can charge a bit more, the letter straightforwardly noted. The gain of roughly 4 million subscribers paled next to the explosion of 15.8 million in the year-ago quarter, when COVID was in its earliest stage. In the current, second quarter ending June 30th, the company expects to add just 1 million more paying customers. The tepid outlook, adding 1 million new subscribers would be the lowest year-over-year growth rate in company history, contributed to the stock price decline. In the letter, the company said the results for the period ending March 31st reflected previous advisories that the record-setting gains would not be able to be sustained. The competitive climate has not affected results, executives insisted. Disney, Apple, NBC Universal, Warner Media, Discovery all launching new services over the past 18 months, and Viacom CBS has also expanded and rebranded CBS All Access. We don't believe competitive intensity materially changed in the quarter or was a material factor in the variances. The over-forecast was across all of our regions, the company said.